Today we're going to cover 2 chapters. I mean, we already covered one, chapter 4. Let's cover another 2 chapters. Am I sharing my screen?
Yes, Professor.
Okay. That will be chapter 5 and chapter 6 altogether. So let's start one after another. Chapter 6. So in reality, there are 2 types of costing systems in the company. Why do we need costing system? Because we need to know the cost, right? How can we sell the product if we don't know the cost of the product? Well, but we have 2 systems that give us the production of the product. One will be the process costing, and the other one is the job costing. Now, what's the difference? The process costing, company produces many units of a single product. So we're not changing the product, we're just producing units. We own the mass production here. So 1 unit for production is exactly the same like every other units in the production. So an identical nature for each unit of production help us to assign the same average cost. How are we going to get it? We're going to get the cost for the period of time for which we incur the cost. Then we're going to see how many units we produce for that particular period of time. And that's how we're going to get the cost per unit. Make sense?
Yes.
Okay.
Yes, Professor.
Good. Which company is going to use this? Most likely this company that doing cement mix, refining oil, and Coca-Cola, which are producing the same product over and over again. So at the end of the period, they're going to calculate the cost for the period divided by the number of units that they produce in that period, and going to come up with the average cost per unit. Done. This is your chapter 6. Chapter 6 is delivered. Now let's focus on chapter 5. Job order costing is another costing system. Job costing is used for when you have many different products each period. Also, product and manufacturing only and only when they are ordered by the customer. So the customer comes, make the order, then we start production. We're not just producing something and hope to sell it. No. We have a different approach. Next thing, the unique nature of each order requires tracing or allocating cost to each job. And then you have to make a record for each particular job. So you have to be super precise here. Example will be aircraft company or some large-scale construction company which have a lot of projects, and the other one will be the greeting cards. So to summarize, job order is used when you have many products or many orders. Cost is accumulated by project or by job only, and average cost is computed by the job and job only. Process costing is used when you have single product and you're not changing the line, same product over and over again. Cost is accumulated by the department level, and the average cost again is computed by the department, not by job. Question for you: which of the following company would likely to use the job order costing rather than process costing?
B, architects.
Okay, what else? Who else?
E,
D, caterer for wedding reception.
Okay, caterer for the wedding and builder for the, okay, good. Those are the 3, great. So let's start chasing how we're gonna get the cost of our product, which is purchased by the customer, right? Because when the customer comes and say, I want to buy cake which is the way, like a birthday cakes, very special, this and this and this. How much is going to cost me? Well, you have to give him a sale price, right? But in order to give him the sale price, you want to have the cost for that cake. So in order to get the cost of the product, what do you need to know? You need to know the direct material, direct labor, manufacturing overhead. Correct? Obviously, direct
Yes.
material, direct labor, that will be the direct cost. Problem comes with the manufacturing overhead because that will include indirect material, indirect labor, and some other costs, which are still costs related to the preparation of the cake. What we're going to do, we're going to create this job cost sheet. Client came, he ordered birth cake, blah, 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 and this and this. He wants those things. So what we're going to do, we're going to see how much material we use for that cake or for this order. So that will be easy. We see the material, we see the quantity of the material, cost per the quantity, come up with the cost. Direct material, easy. Direct labor. We get somebody to work from 8 to 4 o'clock. That's 8 hours. We pay him $11 because we are cheap. And we pay him $88. That's our direct labor. Cost for direct labor, easy. Now we're coming to the problem with the manufacturing overhead. Question for you. Imagine, you already know that manufacturing overhead, usually the cost comes at the end of the period, correct? So in the beginning of the period, we are not certain about the cost of the manufacturing overhead because that's including so many costs like utilities, like a rent, like insurance, like a security, like a cleaning, and all the other things. And some of those costs usually comes at the end of the period. Now, question for you. You open coffee shop. On January 1st, at 6 o'clock, you decide to open a coffee shop, you start business. Right? You're not like those lazy people who taking the January 1st as a start holiday. It's a working day, you know, it's the beginning of the year. If you don't make money in the first day of the year, how are you going to make money on the second or third and fourth? It's not possible. So the way the year starts, that's how it's going to go. If you start spending money on January 1st, that's how it's going to go. The first day is going to determine how the year is going to go. So if you want to make money, work on January 1st. So you decide to work on January 1st at 6 o'clock, you're there, store is open. First customer comes, he's one of you. He's not the lazy guy. He's not taking January 1st as a start holiday. Usually in Canada, people don't celebrate New Year anyway. So the customer comes and he said, can I buy a cup of coffee? And you say, yes, you can buy a cup of coffee. How much going to cost me? And you look at him and say, listen this. You know what? I can easily calculate direct material, direct labor at this point. But for the manufacturing overhead, I'm not certain because I don't know the actual cost. Why don't you come on December 31st when I get all the costs for the manufacturing overhead cost, actual cost, and then I can tell you the price of the coffee. What's going to happen with this customer if you tell him something like this?
It's gonna leave.
He's going to leave. Is he going to come back again?
Never.
No, never. So do you want this to happen?
No.
No. But can you sell him the coffee without accounting for the manufacturing overhead cost?
Can we estimate?
Exactly. So the question is, can you sell him the coffee without manufacturing overhead cost? No.
No.
Why? Because you're going to lose money, correct?
Yeah.
Now the problem is, since I don't have the actual cost, what I'm going to do, and we have the answer. What was the answer that you gave me? Can we estimate? Yes. So, but before to estimate, we have to choose the allocation base. An allocation base will be something that applies to all the orders or all the jobs that we're having in the company. It can be direct labor, can be machine hours, can be direct labor, hours, anything common. So when we use the allocation base, it's impossibly difficult to trace overhead costs. That's why we're using allocation base. We need to allocate somehow the cost based on the allocation base. Why? Because it's difficult and impossible to. Also, manufacturing overhead have so many different items. Many types of manufacturing overhead costs are fixed, even though they fluctuate during the period. And the timing of the payment of the manufacturing overhead cost, it's very different and usually comes at the end of the period. That's why we need to allocate somehow those costs. But first we have to choose the allocation base. Once we choose the allocation base, then what we're gonna do? We're gonna calculate and estimate to our best ability the entire cost, overhead cost, for the period of time, which is next year. Then we're gonna get the allocation base, and if you choose that to be direct labor hours, we're gonna use the direct labor hours. We're gonna estimate the available direct labor hours for the same period for which we calculate and estimate the cost. Right? We cannot be in the different realities. Then we're gonna use the cost as a nominator. We're gonna use the estimated total allocation base for the same period, which is the estimated cost, as a denominator. And we're gonna calculate the predetermined manufacturing overhead rate. Now we have some basis to which we can start applying manufacturing overhead. Now, why do we need this? Well, usually using the predetermined rate makes it possible to estimate the total job cost sooner. Why? Because now we can start applying the manufacturing overhead. Even though it's not actual, but it's due to our best ability and give us the flexibility to calculate. Make sense?
Okay.
The other thing, once we have this, the actual overhead is not known until the end of the period. So instead of waiting for the end of the period, we start applying overhead right at this point. The other thing, predetermined rate, we have to keep in mind the predetermined rate is based on the estimates, which estimates our best estimates. And the predetermined rate is computed before the beginning of the period, and you're not changing it during the period. Once you calculate the predetermined overhead, you never change it during the period. Because if you start changing your predetermined overhead that you're applying to the projects during the period, one project will going to have one cost, the other, the same projects, which will be the same, is going to have a different cost. So that's why you're not changing the predetermined overhead during the period. You're changing it only in the beginning of the period, and you're applying for the entire year that's coming ahead. Now, how are you going to apply it? We already calculated, right? We calculated, now we have to apply it somehow. Well, we're going to use the actual usage of the allocation base. So if we decide our allocation base to be direct labor hour, now we're going to calculate the predetermined manufacturing overhead again based on the best estimates or on the estimation for the direct labor hour for the period, but we're going to apply it by the actual hours used to produce whatever we're producing. Make sense?
Can we see maybe an example so we can be applying it to be more?
Yeah, we're going to see the example, but at this point, I want you to understand. Do you understand how we're applying the overhead? We're using the predetermined manufacturing overhead, which we calculated in the beginning period. And after that, every time when somebody actually work, when the actual direct labor hours is used, we are applying that predetermined overhead. Make sense?
Okay, yes.
Okay. So this company come up with the following estimate. They estimated the total cost for the entire year to be $640,000. Then they choose allocation base to be direct labor hours. And they estimated that for the same year for which they're calculating the cost, the available direct labor hours will be 160,000. Then they divided the cost by the allocation base, and they come up with the predetermined manufacturing overhead rate of $4 for every direct labor hour that somebody's going to work. And that's how they're going to apply it. So in our case, somebody work 8 hours. Remember, on the direct labor. Since somebody work 8 hours, we based on the 8 hours, we're going to apply $4 for every hour. That's additional $32. Now we can calculate the total cost because we have the cost of direct material, direct labor, and manufacturing overhead. And since we see that we produce 2 units on this job, we can come up with the cost per unit, which is $118. Now, the problem is this cost per unit cannot be mistaken by the cost if we have a different client and ask for exactly the same product. The cost is not going to be the same. So that cost per unit is applicable only and only for this particular order. If we have to produce 1 more unit, the cost might not be the same. So on the job costing, don't get mistaken to come up with the idea that, hey, if our average cost will be $118. That's not the case. Because we're dealing with the specific orders by the specific clients, and every order is unique. Next thing, choosing the allocation base. Very important, because if you choose allocation base which doesn't apply to all the jobs that you have, then some of the jobs are not going to carry the overhead. So you have to choose the allocation base which is common for all the jobs in your organization. The cost driver is the factor that's causing the overhead cost. And if the base doesn't drive the cost, then you're going to have inaccurate cost. The most common allocation base, obviously, is the direct labor hours. Okay, so that's with the slides. At this point, I'm going to go open one Excel spreadsheet, and we're going to start working on the Excel spreadsheet. See what you know, what you don't know, and do some application of whatever we just talked about. I talk about. Let's do one new sharing. Can you guys see my screen?
Yes. Yes, Professor.
Wonderful. Okay, so let's make it this one. Like this. All right. What do you know about T accounts? T accounts. What do you know about T accounts? Does this look like a T account for you?
Yeah.
Oh, yes.
Oh, yes. So what the T accounts have? On the left side, what do we have?
Debit.
Debit.
Debit, usually.
Debit.
And on the right side, what do we have?
Credit.
Credit.
Okay. So, how we determine which account has normal balance debit, which account has normal balance credit?
Expenses
How we
have
determine that?
assets and expenditure
So,
and
so
withdrawal.
once you go with the expenses, so listen to this. Once you go with the expenses, you're already wrong because the expenses, they don't have balance. That's the income statement account. That income statement account doesn't have beginning balance, doesn't have ending balance, right?
Yeah.
So the only accounts that have beginning balance and ending balance are the balance sheet accounts, correct? Make sense?
Yeah.
Okay, so again, do you know how to determine which account has beginning balance debit and beginning balance credit? Okay, what's the basic accounting equation, people?
Assets equal to liability
Assets
plus equity.
equal to, sorry,
Assets are equal to
equal,
liabilities plus equity
look at this one. Equal to liability
plus equity.
plus equity. Everybody agree with this?
Yeah.
Yes.
Do I have everybody here on board on this equation?
Yeah.
All right, that's good. So, does this look like a T account for you now?
Yeah,
So can I put then in that case, this should be debit, this should be credit, correct?
Yeah.
normal balance. Yeah.
So what that means? What that means to us means that any asset account, we're going to have normal balance, what? Debit. Every liability and equity account is going to have normal balance,
Credit.
credit. Is that clear for everybody?
Yes.
Yes.
Okay, so we are in manufacturing company. How many inventory accounts in manufacturing company has?
Is raw material, work in process, and finished goods.
So how many accounts are those?
3.
Great. Excellent. So we're going to have our raw materials. Here, we're going to have work in process right here. And right here, we're going to have finished goods. Excellent. In order to we have the product, what do we need? What kind of costs we need? We need direct material, we need direct labor, and we need manufacturing, correct? So, but for the manufacturing overhead, we have to get it from somewhere. For that reason, I'm going to open here a new account, which will be my manufacturing overhead account, which account will be cumulative account. And at the end of the period, this account cannot have any ending balance. Okay? Manufacturing overhead. Manufacturing overhead, again, is cumulative account. It's not balance sheet account. It's not income statement account. It's just cumulative account for the period. And once the period is done, this account has to disappear. So let's go. From where the direct material is going to come? From which account? From raw material account, correct?
Oh, yes, yes.
From the material, what else? We're going to have direct material, but we're also going to have indirect material, correct? Make sense? Is that make sense, people?
Yes, Professor.
Yes, Professor.
So that's how it's going to go. Direct labor. Direct labor is going to come from another account, which this case will be liability account, but we're going to pay payroll payable. And for the payroll payable, let's get rid of those lines. We don't need this one. This one will be the beginning balance. That will be opposite. That will be ending balance because again, it's liability account, right? This one is not correct. This one is not correct, and those two should be go on that direction. So from here, we're going to get the direct labor, indirect labor, right? We're going to have indirect labor and direct labor. Direct labor first is going to come for and going to go to the work in process account, like this, right? And indirect labor is just straight line between one account and the other account. That's our indirect labor. After that, we're going to have many different accounts, mostly payable accounts. That will be other payables. And from here, we're going to have a different costs or different lines here, which will be like this, and coming and coming and coming. That can be for the utilities, and that will be for rent, and that will be for security, and that for the parking, and anything like that. Depreciation, and whatever you name it. Other costs, all other costs. Now, that will represent on the right side in this account, we're going to have the actual cost. And in this side, we're going to have applied cost. Make sense? Now, how are we going to apply manufacturing overhead? What we said, first, in order to get the manufacturing overhead, we have to have predetermined manufacturing overhead rate, which is equal to what? We're going to get the total cost for the period. And that will be total estimated cost, don't forget. Cost for the period. And then we're going to use allocation base or allocation driver, and we're going to get the total estimated usage. That will be total estimated usage of driver or allocation base for the period, for the same period, correct? Are you with me, people?
Yes, Professor. Sorry, I have a question.
Please.
How can we know about the allocation base for the period? I'm not, I got lost about that.
Allocation base, well, we have to estimate it, right? We have to estimate it. We're going to come up with allocation base, which can be, again, direct labor hour, direct machine hour, or direct labor dollar amount, whatever you decide to be. How are we going to come up? You have to sit down and think all the jobs, all the process that they have, which one is something that is common for everything. So you can apply the manufacturing overhead to every single one.
Okay, good.
You'll be the man, right? So once you come up with this, then you start to applying it, and you're gonna apply. It will be apply manufacturing overhead, and that will be on the predetermined manufacturing overhead rate times the actual usage of driver, the driver or the allocation base. Make sense?
Yes, Professor.
Okay, so now we start applying manufacturing overhead. Let's apply the manufacturing overhead. Where's my sheet? Yeah, this one. That's from where the manufacturing overhead is going to come. Now, at the end of the period, what we're going to do at the end of the period? At the end of the period, we're going to calculate all the costs. Right? We're going to calculate all the costs. Let's see the actual cost for the period is $30,000. Oh, what I'm looking for? I'm looking for this one. And let's say that the and we applied $28,000 during the entire period. For the year is over, we're checking what we apply versus what the actual is. So let's see what's happened. We have the direct material, direct labor, manufacturing overhead. Once we have those three, we have cost of goods manufactured, correct? Those
Yes.
cost of goods manufactured is going to go with the other mark. Cost of goods manufactured is going to go to the finished goods. Once we sell the cost of the finished goods, that will become a cost of goods sold, correct?
Yes.
Nothing scary so far. It's all that you know. So what's going to, oops, sorry. I should delete this one. So once we do that, remember, at the end of the day, we have to prepare the income statement. The income statement is going to start with sales. Then we're going to have cost of goods sold. Then we have 1, 2, 3 things, and the rest will be operating income. So our actual cost for the period is $30,000. We applied through the process, first with the manufacturing overhead, then with the cost of goods manufactured, then the cost of goods sold, we applied $28,000. Is that good for us or not? What do you think?
Too much cost?
Sorry?
It's too much cost.
So
Because
listen to this.
we're
Our actual cost is $30,000. We apply to manufacturing overhead, then to cost of goods manufactured, and to the cost of goods sold, $28,000. Is that good for us or not?
oh yeah, because we're not reaching the 30,000.
So is it good for us or not?
It's good.
Why is good?
Because it's less of the predicted cost of 30,000.
Okay, so listen to this carefully then. Remember when the client came, he asked you for the cost. So basically you calculate direct material, direct labor, you apply manufacturing overhead using the predetermined manufacturing overhead rate and the actual usage of the driver. So you told him, you know what, the cost, it's going, and you're doing the calculation, it's going to cost me $10. So I'm going to apply 20% markup. So I'm going to sell it to him at the cost time 1.2. Time 1.2. So I'm going to sell it to the customer for $12. Later on, at the end of the year, you find out that the manufacturing overhead that you're using through the entire year is less than the actual cost that you paid for the same manufacturing overhead. Is that good for you?
Also, I already paid it.
You already paid it. Oh yeah, this is the
So
actual.
it's, yeah, so it's not good for
Is
me.
it good for you now? Is it good for you or not?
No,
No.
because it
Why?
was
Because you didn't account for it, and the cost of your products is it the cost correct? How is your product? Since you're applying less than the actual is, where is your product? Is it overcosted or undercosted?
undercost.
Okay, if your product is undercosted, where is your cost of goods sold? Overstated or understated?
Understated.
Again, cost of goods sold is undercosted, right?
Yes, it's undercosted.
So it's undercosted, right? So if the cost of goods sold is undercosted, understated, where is the operating income? Understated or overstated?
Under 2 because I'm losing money.
Listen this. Your sales are 12. Your cost is 10. How much is your income?
2.
$2. But what we said, this cost of goods sold is understated or overstated? What was it? Your cost is understated. Your cost of goods sold, your product is overstated. No, sorry, understated. Because you under applying the manufacturing overhead. So you under applying the manufacturing overhead. Your cost of the product is lower than should be. So it's understated. Cost of goods sold are understated. It should
Now
be
I got
higher.
it. Yeah.
So operating income will be overstated or understated?
Overstated.
Overstated, right? When the costs are understated, the operating income is overstated. The original cost should be 11. And if we apply the original cost, the operating income is down. But right now it's 2. So that means it's higher than should be. Make sense?
Yeah.
Okay.
Professor, this requires to we have to change the estimated price or the applied price if we found out at the end of the period.
We find out at the end of the period. Remember, this actual cost comes at the end of the period. We don't know what's happening during the period. We found out this on the end of the period. So one possible scenario is when the actual cost is higher than the applied cost. So we have undercosted product and understated cost of goods sold, correct? That will be under costed product. The other option is our applied cost, apply manufacturing overhead to be 33,000. If we apply more, is that good for us? If you apply more overhead to our products, where is our product? Is it overcosted or undercosted?
Overcosted.
Overcosted. Since the product is overcosted, where is the cost of goods sold? Understated or overstated?
Overstated.
Overstated. What's happened with the income? Is it overstated or understated?
It's going to be understated.
Understated. Great. So now you understand it. Good. Now you start applying it. Great. That was great. So is that good for us?
No.
Is it good for us to overcost our products?
No, because we won't have operating income. It's gonna be negative.
No. Listen this. In reality, we're applying more cost to the product. So we're charging the customer more for something that we don't have it. Is this good for us?
Oh, okay. So if the customer is gonna pay it, yes, it's gonna be good for us.
Right. As long as we have the customer, we're okay, right? But
Yeah.
as soon as the customer figure out that we're charging him too much, the customer is going to stop buying from us, correct?
Mm-hmm.
So you can see that either scenario is not favorable for the company. It's not good to be overcosted. It's not good to be undercosted. In both cases, if you're undercosted, you're losing money. If you're overcosted, you can lose the clients. So you understand how important is you to come up with the correct predetermined manufacturing overhead rate. That will be the crucial part. Because so the next scenario will be here. Let's go with the next scenario here. Will be the overcosted state product, and that will be overcosted, overstated cost of goods sold. At the end of the period, we have to close this account. Remember how we can close the account, which is short $2,000 on the debit side. We have to debit it, right? We have to apply more debit here. Make sense? The only way I have to bring this account to zero, people. Do you understand this? I have to bring it to zero at the end of the period.
You have to be balanced, yes.
So in order to bring it to zero, I have only one option. He have to apply here debit to $2,000. When I apply here debit $2,000, then my credit is going to go directly to cost of goods sold. It's going to reduce the cost of goods sold, and it's going to bring me to the actual reality of the operating income, because I'm overstating cost of goods sold. If the other scenario applied 28,000, if that's applied, then my product is undercosted. No, I have to apply here credit of $2,000. So I have to debit accounts. So in this case, I can go directly to the cost of goods sold again, but more appropriate will be if I haven't sell all the products, and if I have some products sitting on the work in process or in finished goods, I to add this cost to those products so I can be correct on the costing. So that's what I'm going to do. How am I going to find out? By the number of units that they produce and the proportion of those number of units. Make sense? All right, so let's go now to the slides. Let's go back to the slides. Applying now what we just learned directly to the slides. Next one. Oops, let's go this. This company required 200 of direct material, 10 direct labor hours at $15 per hour. They estimated that the total overhead cost for the entire year is $760,000. And they estimated that the direct labor hours are 20,000. What will be recorded as a cost of the job for this product? So let's start. Direct material. Do you know the cost of the direct material?
Yes, 200.
200.
200.
Next one. We need direct material, direct labor, manufacturing overhead. Direct labor. Do you know the cost for direct labor?
Yes.
Yes, Professor.
Yes,
15.
How much?
it's 150.
150. Manufacturing overhead. Can we get the predetermined manufacturing overhead rate?
350.
So can we get the predetermined manufacturing overhead rate? how much will be my predetermined manufacturing overhead rate? Who's going to tell me how much will be my predetermined manufacturing overhead rate?
In this case, you need to divide 7.
Well, okay, go for it.
Okay,
Whatever you have to do it and tell me how much will be my predetermined manufacturing.
760 by 20.
Okay. Okay, so how much you get?
38.
38 is my predetermined manufacturing overhead. How I'm going to apply predetermined manufacturing overhead? Based on what? What I'm using as allocation base for calculation of my denominator?
Direct labor.
Direct labor. So how many direct labor hours I use?
It's 30. Oh, okay. We have to multiply 15. No.
Yes. Not 15. How much we have to multiply? How many hours we work?
10.
I saw 10, 10,
No.
yes, 10.
Time.
10.
So now we have all the costs. We have direct material, direct labor, manufacturing overhead. How much is the total cost now?
730.
780. 780
Yeah.
or 730?
730.
30.
730.
Okay, so again, predetermined manufacturing overhead you get in by dividing by total cost divided by the total hours for the period. That's $38 for every single hour when somebody work on this particular project or job or whatever you're going to call it. Now, direct material is given, direct labor hour is easy, manufacturing overhead is $38 for every hour or 10 hours. So the total cost will be $730 for this particular job. Make sense?
Okay, yeah, that makes sense.
All right. So let's see the flow of the documentation. What kind of documents we're going to have in this type of company and how those going to flow. First thing we're going to have is a sales order. We're not producing anything, people, in the job costing until we have actual customer who requires those products. So the production doesn't start until the sales is done. We do starting with the sales, then we start in the production. Once the sales order, we have the sales order, then we have the production order. On the production order, we're going to see direct material applied, direct labor applied, manufacturing overhead. Once we have those manufacturing overhead is going to come from the predetermined manufacturing overhead, which we're calculating in the beginning of the period and we're using and we're not changing to the entire period. Then we're going to have the job cost sheet, which we're going to have all the costs of direct material, direct labor, manufacturing overhead. Once we have all those, we can price our job and we can sell the client. Okay, if I sell it for that much, I'm going to make money. Now, the job order and the flow of the cost. Let's take a look at the flow of the cost with the T accounts that we already did. And again, direct material, first you're purchasing direct material, then you applying direct material. First, you're applying the direct material to work in process directly. Indirect material goes to the manufacturing overhead. In the journal entry, that's first will be the purchase of material. And then we'll have debit work in process for the direct material, debit manufacturing overhead for the indirect material, credit raw material for the material used. Then we're going to have the labor. Labor flows, direct labor and indirect labor. Indirect labor goes directly to the work in process. Indirect labor goes to the manufacturing overhead, both coming from the salaries or wages payable. So the one entry here, work in process for the direct labor, manufacturing overhead for the indirect labor, salaries, wages to acquire that. Now, then on the manufacturing overhead, you're going to have all the other different types of manufacturing overhead which are going to come to you during the period. So that's going to come from the various accounts. But debit always will be the manufacturing overhead. So once you have the manufacturing overhead, then you're going to have the predetermined overhead, right? Predetermined overhead based on the actual usage of the cost driver, you're going to apply the overhead. So when you apply the overhead, it's going to go work in process inventory, credit manufacturing overhead. Now the manufacturing overhead, again, actual overhead, those are going directly on the debit side of the account. Overhead that you're applying using the predetermined overhead, that will be on the credit side, which are going to go to the working process. Not what we're going to do with the non-manufacturing cost. Non-manufacturing cost directly will be expense because those are period costs. There's nothing to do with the product. That will be salary expenses or advertising expenses, anything like that. So again, directly expense from the accounts applicable. Once we have direct material, direct labor manufacturing overhead, we can say now we have cost of goods manufactured. Cost of goods manufactured going to the finished goods. That means debit finished goods, credit work in process. And the last thing that left is when we actually sell the product, the finished goods. When we sell the finished goods, that goes and happens to be cost of goods sold. For the selling, we have first transaction to record the revenue or the sales, cash or accounts receivable on the debit side, credit sales on the credit side. Then you have cost of goods sold to match the sales and finished goods inventory to reduce the units that you sell. At the end of the period, don't forget to go back to the working process, the manufacturing overhead account, and to close that account, because again, that account is cumulative account, cannot have a balance. What are the possible scenarios there? You may have under apply overhead. So when the actual cost is higher than when the actual cost is higher than what you're applying, then you're going to have under apply overhead. That means your product is under costed. That means your cost of goods sold are understated, which means that your income is overstated. The other option is you to over apply overhead. That means you're applying more to what the actual overhead is. In that case, that creates a overcosted product. That means that your cost of goods sold will be overstated and your net income for operating income will be understated in that case. Now let's see what's happened with this company. Now the actual overhead for the year was $650,000 with the total of 170 direct labor hours. As we already know, we're applying the overhead $4 per direct labor hour. So how much we should apply? So how much we already apply using the actual direct labor hours? We already apply 680. Our cost is 650. We already apply 680. Where we are? Overstated or understated? Over apply or under apply? Again, we applied 680. Our actual cost is 650. So what that brings us? Did we over apply overhead or under apply overhead?
Over apply.
Over apply. How much? $30,000. So what we're going to do with the $30,000? Since we over applied, I remember when the overhead is over applied, directly go to the cost of goods sold. you have options to go to the work in process finished goods, but general approach is directly go and adjust cost of goods sold. How are we going to do that? Well, we have to debit manufacturing overhead account and credit cost of goods sold. When we credit cost of goods sold, that's how we're going to reduce the cost of goods sold. Now, the other option is to apply this $30,000 to all the applicable accounts, because we may have products under the work in process, finished goods, and cost of goods sold. If that information is given to us, what we have to do is to see which are the numbers for the work in process, finished goods, and cost of goods sold, get the total. The total will be 100%. Once we get the 100%, then we chase work in process. What's the percentage work in process of 100? That's 10%. Finished goods, that's 30%, and then left 60% for the cost of goods sold. So once we have the percentage, and we know the amount that we have to allocate, which is $30,000, then we're going to apply 10% of the $30,000 to work in process, 30% to the finished goods, and the remaining goes to the cost of goods sold. And that's how we balance it. That's the general entry. So we debit manufacturing overhead with 30,000 to bring the manufacturing overhead account to 0. And we credit all those accounts based again on the allocation based on the percentage. Now, let's see this question. This company had actual manufacturing overhead costs of $1.210 million and a predetermined overhead rate of $4 per machine hours. This company worked 219,000 machine hours during the period. This company manufacturing overhead is what? Is it, which one of those is correct? I'll leave it to you. Tell me what you think.
So, Professor, we have to multiply 4 times 1,210,000, and then
Sorry, which one?
subtract. Yeah, if we multiply $4 per,
Yes.
sorry, $4 per the work hours, no, the work machine hours. That is.
Yeah, okay, machine hours, yes. And then compare it, because one is actual, the other one is applied, right?
And then.
Yeah, you're correct.
Okay. We will have 1 million.
Go for it. Yeah, tell me what you're going to have.
50,000 over applied.
Over applied, how much? Or under applied, how much?
50,000.
Oh, yes, 50,000. Yes.
Over applied or under applied?
No, it's under applied.
Under applied, okay.
Because it's negative. Well,
Under
I got
applied, yeah.
negative.
It's negative.
Right. So basically what we did is our actual cost is higher than we actually applied. Make sense?
Yes.
Okay, good. So what is the consequences? Listen to this carefully now. If the manufacturing overhead is over applied, that means the product is under costed or under applied, under costed. That means cost of goods sold are understated. So we have to increase cost of goods sold, or you have to increase the work in process, finished goods, and cost of goods sold. And that will reduce our operating income. If our manufacturing overhead is over applied, that means we overcost the product. That means cost of goods sold are overstated. That means our operating income is understated. So we have to decrease the cost of goods sold. Or the other alternative is to go to the three accounts and decrease those accounts. Now, question for you. What the effect will have the adjustment in the cost of goods sold for the already over-applied overhead on the net operating income? So we're chasing the effect that we're going to, if we adjust the cost of goods sold because we over-apply overhead, and the effect on the operating income. What's going to happen with the operating income when we make adjustment?
Increase.
Increase. Excellent.
Mhm.
Increase.
Everybody
Yeah.
See that?
Yeah, because
Yes.
it was, yeah. Mhm.
It was overstated, so we're reducing it, so the income is going to go up. Great. So let's do the summary. At the beginning of the period, what we're doing in the beginning of the period, we're estimating the total cost for the manufacturing overhead for the entire period. We're choosing the allocation base, and we're estimating the units of that allocation base, or that driver that drives the cost. And we come up with the predetermined overhead rate. During the period, we're using the predetermined overhead. We're not changing the predetermined overhead during the period. But we're using the actual usage of the allocation base to apply the overhead. At the end of the period, we comparing the actual manufacturing overhead with the one that we already apply using the actual allocation base times the predetermined overhead. Then we're going to have two scenarios, either going to be under apply, either going to be over apply. If it's over applied, then we are allocating the amount to the work in process, finished goods, and cost of goods sold. If it's under applied, we go directly to write off the cost of goods sold. In the general of the cost flow, what's going to happen? Direct material is going to come from the raw material and going to go to the work in process. Indirect material, go for the raw material, goes directly to the manufacturing overhead. Direct labor goes directly to the work in process. Indirect labor goes to the manufacturing overhead account. Then in manufacturing overhead account, it's going to accumulate actual cost, but on the manufacturing overhead account, you're going to apply based on the predetermined manufacturing overhead and the actual usage of the allocation base, you're going to apply manufacturing overhead into the work in process account. Once the goods are completed, become the cost of goods manufactured. Cost of goods manufactured goes to the finished goods. Once the product is sold, from the finished goods become cost of goods sold. At the end of the period, you're comparing the manufacturing overhead, actual versus apply. You're going to have either under apply, either over apply. What's going to happen when we have the multiple predetermined overhead rate? Well, that will be too complicated, so I'm not going to spend time on this. Multiple overhead rate, one overhead is enough. Usage of the technology of language. Now, you know that usually most of the reports are prepared in the PDF document format. PDF document format, there's nothing you can do with that. It's very hard to convert and make any calculation. You see me, I prefer to use Excel because it's easy, visual. You can do modification. You come up with the format on the Word, on the PDF document. Not much flexibility, and it generally is difficult to convert it to Excel. That's why they have these languages, which is electronic data interchange, and web-based programming language, which is extensive markup language, which are more efficient with sharing the information and giving the ability for the users to come up with easy calculation based on the information provided by the companies. And the next thing that I not going to talk, that's appendix. And that's for the predetermined overhead and the capacity. For the people who's going to continue with the accounting courses, they're going to hear about this in the intermediate managerial accounting course. For you, we're done for today.